A very warm welcome to SNS here tonight. We are very pleased to see so many of you here. And my name is Mia Horna-Brandtje, and I'm the CEO of SNS. Today's seminar is a collaboration between SNS and Nationalekonomiska Föreningen. I did a translation myself. I suppose it is Swedish Economics Association. Very good. We both feel very honored to have the visiting professor in international economic policy at Princeton University, Ashoka Mody, here with us today. A warm welcome to you.
Thank you very much.
To your wife. And before settling in Princeton, you had a long number of years at the World Bank and at IMF. And before your current positions in Princeton, you were, among many things, Deputy Director in International Monetary Fund's Research and European Departments. More specifically, as examples, at the IMF, you were responsible for the Article 4 consultations with Germany, Ireland, Switzerland, and Hungary, as well as for the design of Ireland's financial rescue program. So there is someone who knows the economics of Europe here today. And today you will present your recent book on the economic and political problems associated with the euro. We look very much forward to that. A very warm welcome again.
Thank you very much.
And I also want to wish to welcome Susanne Ackum, also with long experience from the issues we're going to discuss today, economist and former state secretary at Ministry for Foreign Affairs, and you will be moderating this seminar. The floor is yours.
Thank you, Mia. Can you hear me? Yes. It's a great pleasure for me to share this seminar today, and for me personally, because as a state secretary, my first meeting in Brussels was in January 2010. And at that meeting, the Minister of Finance from Greece said, I think our budget deficit is a little bit higher than we anticipated. And then it went on in February, March, April. And then one Sunday afternoon in May, Brussels called us up and said, you have to get down to Brussels because we have to discuss Greece. And I think so when I read the book, I personally felt I was sort of at the front seat of what happened 2010 to 2014. But also as an economist, I think this book is extremely timely, because we are a little bit afraid of what's going on in Italy and perhaps what will happen when Merkel will sort of step down as a chancellor. And I think we will get some answers from you today. So without taking much time for myself, please welcome up on the floor Professor Mody.
Thank you very much. Thank you very much. So as you can see, I am of Indian origin, live in the United States, and have devoted the last part, many years of my career to studying the euro. And became intrigued by it because it's such an extraordinary construction. There's nothing like that has happened before. And I just want to make clear that I speak today on a book that has the title Euro Tragedy, but I speak, and I mean it genuinely, as a pro-European. I believe in the post-war European project. I believe that what Europeans achieved between 1950 and 1970, especially in the Treaty of Rome, was an extraordinary achievement. Europeans learned to resolve their differences around conference tables rather than on battlefields. They opened their borders, they created trade, which created prosperity and established peace. I'm here to say that that was not just an extraordinary achievement, it was a magnificent historic achievement. So my entire discussion is based on the euro, where I feel Europe took the wrong turn. Wrong turn not just because the euro itself creates problems, but because in many ways it creates the potential of reversing some of the gains that were achieved between 1950 and 1970. The other caveat that I do want to make clear right in the beginning, because sometimes there is an easy misinterpretation of what I'm saying. I'm not blaming all of the problems of the Eurozone on the euro. There are many underlying problems that are common to all Western democracies. Slow productivity growth, the rise of what people call populism. I don't use the word populism, I use the word protest movements, anti-established movements. What I am going to say is that the euro makes each one of these otherwise already difficult matters worse. It makes the productivity growth worse, it accentuates the protest movements, and because it makes these, both the economics and politics worse, it creates a level of financial risk that potentially has enormous wide-ranging consequences. And it is that risk, that financial risk, and its eventual consequences that I'm most concerned about. So I am saying that the euro adds to and amplifies existing tendencies in ways that could have some very severe outcomes. That's the story. The euro appears sometime, the idea of the euro appears sometime in 1970. It is a French initiative. Georges Pompidou had just become French president. And they appointed something called the Werner Committee report. And the Werner Committee report said that you need, if you want a monetary union, you need to have a fiscal union. Okay? A monetary union has a very simple problem. A single currency does not work for all countries. A single monetary policy is a case of one size that fits none. So it's too tight for the weak countries, it is too loose for the strong countries. Therefore, it increases the divergence between countries. That was the point made by Nicholas Kaldor, one of the great economists of the 20th century, right in March of 1971. Few months after the Werner Committee report came out, he said, look, this is a bad idea. The Werner Committee report understood this problem. And Werner Committee report said, yes, we understand it's a bad idea, and we understand that eventually a common budget will be needed, but the political willingness to have a common budget that will create fiscal transfers is simply not there. Therefore, let's start. Let's start the process, and we Europeans will come together. The monetary union will act as a catalyst to create a political union, something that has the look and feel of a United States of Europe, and within that, a fiscal union will be created, a federal budget will be created, and in that federal structure, the monetary union will then work fine. And Kaldor said, no, that also will not happen. He said, because a single currency, a single monetary policy will aggravate the differences, pre-existing differences, and make them worse, it will actually create political disunity rather than political unity needed to come together. If already in the post-war period, even in the shadow of the war, you have not been able to achieve political unity, then adding the euro, which creates more disunity, is going to make matters worse. And he used this biblical phrase, a house divided against itself cannot stand. So he, in a sense, predicted that this could end really badly. To that, the Europeans said, we understand that, but we are Europeans. We have come out of wars. We know that nationalism is an archaic concept, and we plan to create a post-national society within which we will be in the vanguard of a new form of world government. And we will, in that society, give up the concepts of nationalism. To that, Robert Marjolaine, for those of you who remember Marjolaine, was one of the catalysts of the Treaty of Rome, one of the great post-war Eurocrats, a Frenchman, said, even that is wrong. He said that the nation-state is well and alive. This was in the mid-70s, for about 5-6 years, till he died in the early 80s. Marjolaine kept repeating that nationalism remains a very important theme in Europe. Nation-states will not give up their core sovereignty. They will in particular not give up their rights to tax and spend. Hence, the idea that there will eventually be something like a political union within which there will be a fiscal union is completely unreasonable. Marjolaine was asked 2 or 3 times to write reports on how a monetary union can be constructed, and each time he said, I don't want to waste time trying to do this because it is in the end a fruitless idea. I call Marjolaine's idea of a rooted nationalism, I call it a sovereignty barrier. A sovereignty barrier in the sense there are core sovereign rights like taxing and spending that nation states will not give up or will give up in a way under duress, which will create political anxieties and divisions, as we have seen through the course of this crisis. So the French kept pushing for a single currency. Mitterrand from Pompidou onwards, because they felt that the depreciation of the currency, especially against the Deutschmark, was a humiliation, a recurrent humiliation, and they believed somehow that making the French franc disappear into the miasma of a single currency will avoid that humiliation. There was no clear economic concept behind the French proposals. French kept saying we want it. The Germans kept saying good idea, but not now. And that was the Germans could never say no to the French because they still felt somewhat beholden to them. And so it just kept going. And if history had run its course, that's what the Germans would have said, and there would have been no euro. So one of my themes is that the euro actually was not destined to happen. There was no real reason why the euro would occur. There was no historical inevitability to it. And it most likely would not have happened. But then comes along Charles Helmut Kohl, who completely understood the critique that Kaldor had made of the euro. He understood that you do not have a single currency or a single monetary policy for divergent countries. He said in a letter to François Mitterrand that a monetary union is like a bad speech you give on a Sunday and you get up on Monday morning and said, now what exactly did I say? But for reasons over a period of a decade, he convinced himself that this was something he wanted to do, to leave a legacy. And so he gave the French the euro they wanted, but he gave it to them on German terms. And that is very crucial to understand what we are witnessing today. On April 24, 1999, when he sought the authorization of the Bundestag for Germany to give up the Deutschmark, Kohl said twice. The language is very complicated, but its translation is very simple. It said, Germany will not pay the bills of other countries. And he said it second time. He said, in case you didn't hear me, I'm going to say it a second time. Germany will not pay the bills of other countries. Kohl understood that the German public was deeply opposed to the idea of giving up the Deutschmark. So this was his contract with the German public, that we will give up the Deutschmark, but we will not pay the bills of other countries. And so he created this mantra, Euro will ensure Europe's peace, which only he understood what it meant. And so Europe was embarked on this project where a monetary union was created, and there was some vision that there will eventually be a political union, but not how you would get there or what the plan was. And this guy is the legendary American baseball player Yogi Berra, well known for his pithy sayings like, the future ain't what it used to be. If you reach a fork in the road, take it. And here I've used the phrase, if you don't know where you're going, you end up someplace else. And that's the theme of my book, that Europe did not know where it was going. It got into it by a historical accident and then has spent the rest of the decades trying to figure out where it is and what it wants to do. So the rest of the presentation, I'm going to show you lots of graphs which will illustrate the point. So the first point is that the criticism that Nicholas Kaldor had made in 1971 basically came out to be exactly as he had predicted it. Many others predicted it later. In the 90s, Milton Friedman, Marty Feldstein. But Kaldor had noticed this right in March of 1971. And so you see the divergence here. You see Italy per capita income has gone down. If you go back to 1999, Italy's per capita income is still down. Italy is one of those rare advanced countries that over a period of 2 decades has become poorer than it was at the start of the 1999. Germany has gone up. And France, since the crisis, has also flattened out. So the French economy is growing extremely slowly. In per capita terms, is barely going. So this divergence is essentially what Kaldor had predicted. And behind this divergence is sort of a broader divergence between the so-called north and south of the Eurozone. So this is the south, which has a large public debt, and the debt increased during the course of the crisis. This is the north, which has lower public debt and remained broadly contained during the crisis. More seriously, the south has much higher levels of youth distress in terms of youth unemployment and inactivity. The north has much lower levels. And behind that are the institutional structure. The south has much weaker institutions as measured by the World Bank. The north has much stronger institutions, which means there's greater government effectiveness, better regulatory quality, better rule of law, less corruption. And so you have this group of countries with weak institutions. Weak institutions implies low long-term growth. It implies low resilience to shocks. So the weak countries, therefore, when there's adversity, particularly require the help of exchange rate depreciation and supportive monetary and fiscal policy, whereas the strong countries require that less. And because the Eurozone has given up its ability, the members of the Eurozone have given up their ability to depreciate their exchange rate. These countries, when there is a crisis, tend to suffer from prolonged recessions. And prolonged recessions, therefore, are not only enervating in themselves, but the longer you stay in recession, the unemployed remain unemployed, they lose their skills, the investment declines, the R&D declines, and therefore even long-term growth potential declines. So in that sense, the euro is a source of further undermining growth potential over and above the historical trends that are shared by every country. And the final chart I'll show you on the differences. This is the South. You see the research and development, 1997, 2016, basically remained in the low area of 1% of 1.5% of GDP. This is the North. France is actually in the South. I'll show you in a second a chart. French R&D is not very productive. You know where Sweden is, and East Asia is somewhere over here. So you have this phenomenon that this group of countries is not able to compete in world economies through an innovative process. But this group of countries is too rich to compete on the basis of low wages. So when people say the Italians should cut their wages, the Italians would have to cut their wages down to Romanian levels to be able to compete in some of the products that they need to compete in. So if Italy has hourly wage rates of 16, 17, 18 euros an hour, and you want to go down to 6, 7, 8, that would be socially devastating, and it would just simply not be politically acceptable. So they are trapped in a situation where they do not have a growth model. They therefore have grown historically by allowing their exchange rate to depreciate. Exchange rate depreciation makes a country poorer, but it creates a cushion as shock absorber against crisis. One other consequence of this is that Germany has now started trading less. France was its main trading partner. That has reduced. Italy, it's trading less with Italy, more with China, and particularly more with some of the Eastern European countries that do not have the euro. I put up this chart mainly to show that sometimes you will hear the phrase that a single currency is needed for a single market. That is not true. You can see the rapid increase in trade with countries that are in the single market but do not share a single currency. And that's a very, very well-known fact that, Canada and the United States have a free trade agreement. You don't need, it's not as deep as the free single market in Europe, but you don't need a single currency. People exchange currencies. People have ways of hedging currency risk. This also undercuts the argument that you need a single currency because single currency will promote trade and that trade will promote prosperity. And so the econometric studies confirm the idea that the single currency does not do that. And so you really don't get any growth benefit from the euro. And you create these enormous risks of prolonging recessions that could transform into crises. So the euro, in my sort of interpretation, doesn't have any upside, but it has lots of downsides. And so you have Kaldor's ghost also stalks the Eurozone politics. And you see over here during the course of the crisis that the Italians lost trust in the European Union, Germans much less so, France in between, exactly in line with their economic performance. And then the evolution of this political development into the political process occurs sometime in 2011, 12, and 13, at the height of the Eurozone crisis. Chancellor Merkel at that point effectively becomes European Chancellor. She's a European Chancellor in the sense that she has veto authority over all major European decisions, in terms of the bailout decisions, in terms of the financing decisions. And so she becomes, in effect, the funnel through which all decisions are made. Her achievement is that she keeps the Eurozone together. Barely so, but she keeps the Eurozone together. But in so doing, she alienates everybody. She alienates the Germans, who believe that she's doing too much for the southern countries. And so you see the birth of the Alternative for Deutschland party. The Alternative for Deutschland party spins off from her Christian Democratic Union, people who feel that Merkel is leaning too heavily in favor of the southern countries. And at the same time, you see the birth of the Five-Star Movement in Italy, because the Italians feel that Merkel is dictating policies to them and acting in undemocratic ways. There was the removal of Berlusconi that was viewed widely in Italy as an act that was engineered by Chancellor Merkel to remove a democratically elected, even though the world sees Berlusconi in a very negative light. The fact that a foreign authority may have had a role in getting rid of a nationally elected leader bristled and hurt the sentiments of the public. In any case, it was made an electoral issue of creating a non-democratic structure, and from that grew the Five-Star Movement. So again, I'm not saying that these movements are growing because of the euro, but they are certainly being amplified because of the euro. The AfD in particular is, at that moment, a completely new party born explicitly as an anti-euro party. Maybe the AfD would have emerged in any case, but its birth is 100% tied to an anti-euro movement. So I'll run through very quickly some current developments, because I make the claim that although my book is a history book, its framework can be used to interpret a number of ongoing discussions in the Eurozone. Very quickly on Greece. The Greek output has fallen by 25%. This is probably a well-known fact to everybody. This is the comparison with the Great Depression, where it also fell, but it bounced back. In Greece, we do not yet see any sign of it bouncing back. Maybe a little recovery, but no bounce back. But more importantly, Greece has been required now by its creditors, to whom the official creditors to whom Greece still owes large amounts of money, that Greece will maintain a very tight fiscal policy. Not only maintain a tight fiscal policy, but the Greek parliament will not be able to take any independent decision that is not authorized by Berlin, Brussels or Frankfurt. In effect, the Greek parliament may as well not exist for making fiscal policy, because every fiscal policy decision will have to be reviewed and confirmed by these external creditors. And so there is no democratic accountability in the process. In Greek democracy, in this crucial respect, over the next 2 generations, as long as it has to repay the debt, has been severely undermined. This is a sort of somewhat important theme. This relates to the question of how the Eurozone is functioning. I use the phrase political limits because the ECB has a governing council, and the governing council has members from all the member countries, and the member countries then bring their national interests to bear in the monetary policy decisions. And as I'll show you in a minute, those national interest preferences lead to the policies being made in certain ways. And today it's reaching limits in a way that I'm going to show you in a second. So one of the things that happens sometime in late 2012 is that Eurozone inflation starts falling, whereas the American inflation, somewhat erratic, but eventually rising. So US inflation has reached 2%. Eurozone inflation is stuck around an average of 1%. Normally, people believe that low inflation is good, but prolonged periods of low inflation tend to create low growth and increased debt burdens, because people expect so around this 1%, Italian inflation is closer to 0.6%. What this means is that there will be an incentive for consumers and investors to believe that, well, maybe prices will remain low, maybe prices may even fall, therefore they postpone their decisions, which means growth remains low, which means debt burdens become harder to repay. Hence, central banks fight deflation as a plague, and that's exactly what the Federal Reserve did during this period. Ben Bernanke, the Federal Reserve chairman, was both publicly and through his actions taking very aggressive efforts to fight off the threat of deflation. In the Eurozone, that was not a priority because the Germans and the northern countries did not view that as a priority. What that meant is that the Eurozone has fallen into this trap where because inflation remains low, spending remains weak, which means that inflation remains low. So the ability of monetary policy to raise inflation has become compromised. And these charts you see, these dotted lines are the ECB's inflation forecast. ECB continuously forecasts that inflation will rise, but inflation remains stubbornly low because the connection between monetary policy and inflation has become much weaker. I'm going to skip this chart because the basic theme on this chart is that when you have bond purchases, you tend to reduce the interest rates, and the reduction of interest rates causes the exchange rate to depreciate. But because the ECB arrived with its bond purchases much too late and then threatened to withdraw them very quickly, the ECB also did not get much of a bang in terms of exchange rate depreciation. So in my reading of the data, the ECB could not move inflation very much, could not move the exchange rate very much, and it could not also do very much for growth. This is the early period in which the ECB bond purchases did begin, but growth remained relatively flat because world trade growth was relatively low. The one lesson I learned in writing the book is that all European economies, tend to move in tandem with world trade, because European economies are small and so they are heavily dependent on world trade. When world trade is doing well, European economies grow. When world trade is doing poorly, European economies tend to do poorly. And you see this feature in this chart in 2017 when world trade picks up, because China injects a lot of stimulus into its domestic economy. That stimulus leads China to import and export a lot more, which increases world trade. European economies begin to grow fast. China is reducing its stimulus and the growth is beginning to fall. Italian growth is now coming virtually into recessionary conditions. Yesterday we had data which showed that in the last quarter the Italian economy has not grown. So the Italian economy is suffering from low inflation, is about to tip into a possible recession, and that is sort of the legacy of the ECB being unable to move either growth or inflation in a meaningful way. Very quickly on Italy, I call Italy the theater of Euro tragedy because all the pathologies of the Eurozone come together in Italy. And that is why it becomes the fulcrum or the key point around which a crisis could have very wide-ranging implications. So the Italian lira continuously depreciated in the years before the euro was introduced. After the euro was introduced, this is the euro-dollar exchange rate. It has fluctuated, but today the euro-dollar exchange rate is very close to where it was in 1999. What does that mean? That because the euro has both the lira and the Deutschmark within it, the lira has not depreciated for 20 years against the Deutschmark. The lira has not depreciated against the US dollar for 20 years. But during this period, Italian productivity growth has been negative. So Italy suffers from the double liability of having a negative productivity growth, which makes it less competitive, and it's unable to depreciate its exchange rate because it does not have an exchange rate of its own. So the combination implies that Italy suffers from a chronic low growth and a chronic tendency to relapse into recessions. And those recessions get prolonged and then lead to the risk of financial crisis. The result is young educated Italians, college graduates, are leaving Italy in larger numbers. And this is what the economists call a doom loop. The Italian interest rates on Italian government bonds is rising, the bank stocks are falling, and weak banks create the risk that the government may have to bail them out, which then creates a further liability on the government, which then further raises their interest rates. And as those interest rates rise, the banks suffer further. If that is combined also with recessionary conditions, the doom loop says a weak economy will pull down weak banks, which will in turn make the finances of the Italian government weaker. So the weakness gets amplified in the system, and we are at a point where that weakness is reaching a critical threshold. And a further continuation of weak growth and rising bond yields and lower bank prices could tip Italy from what is a broadly sustainable, barely sustainable conjuncture to something that becomes unmanageable. Sovereignty barrier remains as strong as ever. This is the Marjolaine theme. This is the Franco-German relationship. Many people say that eventually the French and Germans come together and solve Europe's problems. The relationship between France and Germany has become very imbalanced in terms of economic strength. So while the French do like to believe that they are equal partners, this is in fact the more realistic relationship. This is also then François Hollande over here in 2012. And the story that I tell in this note over here is that in 2012, Herman van Rompuy an important Eurocrat, proposed a Eurozone budget, the same budget that could not be achieved in 1970. In the Werner Committee report, that discussion comes up Groundhog Day style every few years. And so when he proposed it, Merkel says to him, "And where will the money come from?" And François Hollande says, "No, don't think of it as a Eurozone budget. It's a solidarity fund." And so Merkel turns to him and says, "And where will the money come from?" And so that is the constant theme in the German discourse. That's the promise that Helmut Kohl made to the Bundestag. We will not pay the bills of others. A German chancellor, that is the answer the German chancellor will always give. Where will the money come from? And therefore the idea of a common budget, Eurobonds, safe assets, common deposit insurance, all of these ideas founded on the same basic sovereignty barrier. And so Emmanuel Macron comes along and people like to believe that he will be the savior. He will create a new dynamic. Very soon his poll ratings begin to fall because he's not delivering to his own people a sense of optimism. And the relationship with Merkel remains the same, and Merkel now in kinder words than before says yes, we will talk about it, but not quite now. And that's sort of the central German strategy, yes, but not now. And so the discussion keeps going. And this is my last chart. I just want to end by saying that while all this sort of drama about the euro is going on, and we are reaching a point where there may in fact be a Eurozone crisis with Italy as the epicenter, European nations, especially in the Eurozone, are becoming second-rate economic powers. So two features of this chart. In 1995, these are patents registered by companies in the US Patent Office. Korea was here, Germany was here. So this was the gap between Korea and Germany. Germany has done reasonably well, but Korea today has twice the number of patents that the Germans have. China, which was almost zero, is exploding in the next 10 years, will probably match Germany, and France and Italy remain trolling the bottom. So I end by saying that this is a American cartoon character named Pogo who was sent out to find where the enemy was, and he came back and said, "I have looked, and the enemy is us." I feel a lot like that when I hear the discussions in the Eurozone today. There's a confrontational attitude in all of the discussions, even as we see the Italian discussion unfold today. The debate between the public debate and the recriminations and the harsh statements made on both sides by the Italians as well as by the commissions and by the media are raising the temperature. Instead of trying to create a constructive dialogue, the animosities continue to increase, the stereotyping continues to increase. This was predictable. This is what the economics said. The Europeans tried to use a political bludgeon to overcome the logic of economics. But economics had its revenge, and economics always has its revenge. And so we see a tragedy in the sense that it need not have been. There was no good reason for it. And it could get worse, but potentially a lot worse. So I promised you that I will tell you a grim story. I think I have delivered on that. So I'm going to now ask Susanne to...
Thank you, Professor Mody. Thank you very much for your interesting talk. And let's take place on these chairs and let's bring on some water. I've been told that we have to keep short questions. Please state your name. And you should wait for the microphone. But since I am the moderator, and since this is a story, sort of a little bit of my life, 4 years, one thing that you didn't talk that much about is what I felt we were doing during the 4 years that we'd sort of changed the scene from going from more market pressure to peer pressure. And I think we talked about that during lunch. And my Finnish colleague said that that was a great mistake. And I think you agree. Could you elaborate a little bit on that?
I think that's a very, very, very crucial point. So one of the themes at Maastricht in 1991, and then just it happens today that the Maastricht Treaty was signed on 1st November 1993. It's 25 years today. Was how to create discipline in the public finances of countries. And the debate was exactly as Susanne is saying. Should it be peer pressure through so-called fiscal rules, or should it be more market-based, which is that if countries misbehave in their public finances, their creditors will bear the cost, and because creditors know they will bear the cost, they will create a discipline in terms of increasing interest rates. My view always has been that this peer pressure system does not work. It does not work because the rules tend to make matters worse, as we are seeing right now in the Italian case. Italy is almost tipping into a recession, but the rules require Italy to have fiscal austerity. And austerity at the time of a recession is exactly the wrong thing to do. We learned as you lived through that very story in the Greece context. In the Greece context, Greece was tipping into a recession. The austerity made the recession much worse, which is why you see that red line where the output kept falling and the insistence on more austerity, because as the output falls, the debt burden increases. And so you see the rising debt burden and you say, oops, you need more austerity, which makes matters worse. So the rules are stupid. And this is a phrase that Romano Prodi used in 2002, 2003. But there's some view in Europe that a bad rule is better than no rule. And it makes no logical sense. But it is a mantra that is very much part of the system. The peer pressure then, as much as it exists, is conducting a hostile war of words in public, and in your conference rooms, I'm sure you saw even more the hostility displayed. It does not serve a purpose. It increases animosities and therefore makes matters worse. I would much rather see a market-based system, and the reluctance to move in that direction remains still mysteriously deep to me.
Mm-hmm. We have a question over here.
I am Marian Radetzky. I am a student of economics. Thank you very much for this enlightening presentation of what has been and what is today. But I would like you now to be more visionary and to look into the future. When will we see the complete failure of the euro? And how will that failure evolve? Would you please tell us a little bit about your thinking on those issues?
So the first principle of forecasting is, if you predict something, don't predict when it will happen. So the evolution of the failure is sketched out in the book. And in a way, I'm somewhat sort of embarrassed to say it is, and saddened to say, it is playing out very much in the form I sketched out sometime last year as I was finalizing my book. And it is the Italian crisis. Italy has always been the fault line of the Eurozone. Everybody knew Italy did not belong to the Eurozone. And you saw you have negative productivity growth, no exchange rate depreciation, you have a problem. I think the way the crisis could evolve is that this doom loop of low growth, more stressed banks, more stretched public finances feeds on each other. Remember, the reason Italy is so important is that it's very large. It's, in terms of financial assets, it is about 7 times that of Greece. So Italian sovereign debt is about the same size as the German sovereign debt and the French sovereign debt. Italian bank assets are also almost of the same size as German and French bank assets. So if there is increasing stress within such a large system, the ability to bail Italy out becomes almost impossible. The political limits theme that I mentioned about the European Central Bank is very much this, that if the European Central Bank is asked to bail Italy out, the ECB already owns something like 20% of Italian debt. If in addition, in the course of trying to bail Italy out, it has to acquire another 15-20% of Italian debt, the politics of the governing board will rebel against that. The question will be if the ECB acquires that much debt and then the Italians default, those losses then will have to be borne by the other member countries. So the ability of the system to rescue Italy is very compromised, and the Italian crisis could all too imminently happen. That's the scenario within which the beginning of the end occurs.
John.
John Hastle, Stockholm University. You didn't talk much about the counterfactual, and I mean I can see a counterfactual that would have been much better for the southern European countries, like an independent central bank with a bit higher inflation target than the northern countries, and sound fiscal policy with ambitious stabilization motives. But I could also see something that would be much worse with sovereign debt crisis, maybe hyperinflation and so on. So what should we compare this with?
Right. So look, that's a very good question. And let me just say that a lot of my friends will say, well, if Italy had not been in the Eurozone, it would have been like Argentina. It would have been much worse. And let's stipulate that's true. I mean, maybe that would be true. The main thing about that is that it would have been an Italian problem. Mm. Now an Italian problem is a Eurozone problem, and therefore has much bigger financial risks. Today, the big risk is that if Italy is not able to manage in the Eurozone, and there's a threat of Italy leaving the Eurozone, that threat creates the risk that the Italians will have to move to a lira, which will mean that their ability to repay their debts will be compromised, which will lead to a set of cascading defaults. And those cascading defaults could have huge repercussions for Europe and for the world economy. If Italy was on its own, it would have its lira debts, it would default on them, it would be a much more contained affair than it is now. Now it is tied into the payment systems of the Eurozone through the exchange rate, and the depreciation of the exchange rate would have such an enormous effect on its liabilities, would blow up its liabilities to such an enormous extent that it could create a huge problem. So it's possible that Italy would have performed worse, but it would have been a largely Italian problem. Now it will be a European and global problem.
There's a question.
I'll speak loudly.
Stand up.
I'll speak loudly. So, I'm an Italian student at Stockholm School of Economics, and I was wondering about this. So, according to many financial institutions, and as according to also previous economic business cycles, we're approaching the end of the business cycle, and there is a likelihood that in the next 2 or 3 years there will be some kind of crisis somewhere in the world. Mm-hmm. I wonder. So let's suppose that there is a crisis in the next few years, and that Italy is affected. Is there, it's a difficult question, is there a possibility that Italy might leave the Eurozone? How strong is our Italian economic fundamentals with this regard to withstand an economic shock? And could Italy leaving the Eurozone affect the survival itself of the Eurozone?
Yeah, so, the only thing I would say in terms of the premise of your question, we don't have to wait 2 or 3 years for the end of the cycle. We are already seeing that Italian economy is in recession. Not in recession, sorry, take that back. Italian economy grew at 0% in the last quarter. If world trade continues to slow, as I expect will happen, the Italian economy will fall into recession in the next quarter, 2 quarters of recession. And if further austerity and or this sort of war of words continues, the yields will tend to keep going up, and Italy is already in a crisis at that point. As I said, an Italian crisis will then raise some existential questions about what should be the way to support Italy if the recession actually turns into a crisis through this doom loop. Then the ability to rescue Italy becomes very compromised, and that could have enormous implications, as I said in my answer to the previous question.
There is a question. Front.
Jonas Rengård, SEB. The old Greeks, when they wrote their tragedies, always had a solution.
Yeah.
When the things became too complicated, they sent in a couple of gods through the floor or something. Deus ex machina. What would your be your proposed solution? What would your gods do in order to solve this? Because it sounds very inevitable what you are describing.
Yeah, so, there are sort of 3 layers to this. If, in fact, there is no immediate crisis, then my sort of more palliative solutions is to move from the fiscal rule, peer pressure-based fiscal rule, over a graduated period. And I emphasize the graduated period because moving to market discipline quickly can be very disruptive. So over maybe a period of 5 to 7 years to move in that direction. I would also say that we would want to have the European Central Bank not focus only on inflation, but also on unemployment. That will tilt the ECB policy in the direction of favoring the southern countries. This, by the way, is not an original proposal. It was made by Franco Modigliani, a Nobel laureate at MIT, in 1998. It's a policy that the European Central Bank and European officials completely disregard and dismiss. So those would be my palliative solutions. I think that would make for a better economic policy structure within which the Eurozone operates. It will reduce some of the mindless austerity and the sort of unnecessary monetary policy tightness. Whether that will be enough, I don't know. If there is, in fact, despite that, a crisis, and there is a possibility of an Italian exit, then what I've written in the book, and I've written many times also in public, and it's a view that others have said that the least disorderly way, the least disruptive, the least costly way of breaking up the Eurozone is for Germany to exit the Eurozone. A German exit causes Germany costs, but it does not, unlike in the case of the Italian exit, it does not cause global financial spillovers. Germany will be largely able to contain those costs within Germany, and therefore the broader implications will be less serious. Those are my sort of two themes, that if there's no crisis, try to get this right through the mechanisms I outlined. Otherwise, Germany exits. My broader theme is that ultimately none of this is going to work unless Europeans invest in their future. And so I have this speech, an imaginary speech by Chancellor Merkel at the end, which I call her exit speech. It may be time for her very soon to give that exit speech. That Europeans have to invest in their future and they're lagging behind in education, R&D, innovation, and unless they do that, none of the above really matters. That we know historically growth is associated with better ideas and higher productivity that comes from better ideas, and that is where the real European failure is. That is my pro-European vision, that we see a Europe that returns to what I believe Europe was in the Enlightenment period, where nation-states competed with each other in the marketplace for ideas. That is what I hope will happen. It has nothing to do with the euro at one level, in the sense that it does not solve the euro's problems. But if the euro continues to exist, a Europe that is more technologically vibrant will make the euro's problems seem much less important than they are in a situation where growth tends to be low and the compromises are much harder to make.
Thanks very much. My name is Kristen Magnuson Barnard. I'm with Nordea Bank, but I spent 6 years in the Troika from all three institutions. So this was, just like Susanne, a big piece of my life for a long time as well. I will try to spin a somewhat more positive counterfactual, not necessarily because I believe in it, but it might be interesting to hear your views on it. Lots of people say it took a long, long time for the US to function as a monetary union. We didn't have banking supervision until the last 100 years or something. It took a long time before the fiscal federalist powers were there. Why are we not just too early to throw out the euro already?
Yeah, I think, look, again, a very good question. Let me answer that carefully. There's a major difference between the US and Europe. The Americans fought a war of independence in 1776. Between 1776 and 1785, America looked a lot like what Europe looks like. That there wasn't sort of a clear center of authority. In 1785, they got together, 1785, they got together and wrote a constitution and created a federal government. And that's the big difference. That they have a political contract within a constitution, which then creates a system within which a federal government exists, can create compromises across states, can create decisions that become binding on everybody else in a democratically legitimate way. There is nothing like that in Europe. And the sovereignty barrier, in my view, implies there never will be anything like that in Europe. I'm not even sure it is normatively a good idea for Europe to have a federal United States of Europe government, other than perhaps for making the Eurozone function better. The nation state is a vibrant source of dynamism. And the nation state can obviously, the nationalisms can obviously get out of hand and create problems. But to reject the idea that the nation state actually can be a source of dynamism is wrong. But just in a predictive way, I do not see a conjuncture within which people will say, you know what, we'll make the Bundestag like a parliament of a lander in a broader European parliament. So the European Parliament, in effect, becomes the parliament of all of Europe. It makes all the fiscal decisions like the US Congress makes. I don't see a day like that. And unless a day like that occurs, then all that you talk about, the Federalist movement, the creation of the banking union, all of that occurs within a political framework that has democratic accountability and legitimacy. Today there is no such framework. The substitute is something called the European Council. But the European Council is basically a jockeying of national interests within which some are stronger and others are weaker. So it always has this sense of lack of accountability and lack of legitimacy.
Thank you. We take one more question.
Mats Hellström is my name. For those who think that the single common market is the most important aspect of the European Union, there's also, of course, the other argument that to keep the single market alive with a level playing field long time, you would need a common currency to prevent devaluations, competitive devaluations. Now, of course, we are not there. Not all are in the common currency. But as a goal, like I think the Dahrendorf crown theory, wouldn't a single market that really will function in the long term need a common currency to avoid retaliatory devaluations?
I gave you a part of the answer to that question, but let me elaborate. The part of the answer I gave you is that you see that Germany is trading a lot more with Czech Republic, Hungary, and Poland. They don't have a common currency. It does not in any way impede the functioning of the single market. But the broader question that you're raising of competitive devaluations. Competitive devaluation seems like an attractive way to further your economy. But remember, a country devalues. When a country devalues, it becomes poorer. And no country willfully wants to continuously become poorer to gain a short-term advantage over other countries. And so the notion of competitive devaluation was very popular around the breakdown of the Bretton Woods in the 1970s. But there's the rest of the world that works on floating exchange rates. They don't competitively devalue all the time. There's no reason. Canada does not competitively devalue to try to gain an advantage over the Americans. The Mexicans don't try to competitively devalue to gain an advantage against the Canadians. Competitive devaluation can be a very short-term phenomenon, but it's not a long-term strategy for growth. No one has ever proved that it's a long-term strategy for growth. Therefore, both the evidence that we see that there is flourishing trade between the euro and non-euro countries in the single market, and the logical analysis says that there is no reason for a single currency to support a single market.
Thank you very much, Professor Mody. This has been very interesting, and we are very grateful for you to putting this book together. And personally, I'd like to summarize and rephrase Erik Lindahl that I'm still worried, but on a much higher level. Thank you.
Thank you very much.
So it's just for me to add my great appreciations for sharing your insights with us here today on a very, very stressful situation that you described so well. And also for Susanne of leading this discussion. And thank you also very much for the Swedish Economic Association to involve us in this and to have this seminar together. I think it has raised a number of issues we're going to come back to in different ways. And we welcome you back again.
Okay, thank you very much. Thank you very, very much.